Indeed, it has been a very interesting week. Just a week ago, today, in fact, President Trump announced his latest tariffs that have since sparked off extreme volatility in the market. You can see in the chart on the bottom right-hand side how the equity markets have reacted, how the volatility index, which measures volatility in the market, touched 60 just for the fourth time in its history. Just for context, the VIX touched 90 back in the global financial crisis and 85 during COVID. So equity markets have experienced, the worst sell-off since the COVID era, February 2020, wiping out a reported 10 trillion from the equity markets in a space of 3 days. And rates haven't been immune either. US Treasuries, bonds, and gilts have all sold off earlier this week and in fact they're still selling off on fears of higher inflation, possibility of foreign holders reducing or disposing their treasury assets, and the chances of government having to provide stimulus packages to counter the impact of tariffs to economic growth. You can see in the top right slide that the commodity markets, which as we know are very important to the continent, have also suffered. Oil has gone down by about 15% over the last 1 week and touched below 60 earlier this morning. So it's been quite a hectic 1 week, primarily due to what's in the announcements made last week on the 2nd, and some of the rhetoric we've been seeing coming out of China and Europe as well. So sovereign emerging market credit had remained resilient, particularly African sovereign credit. And I'm now referring to the chart on the bottom left-hand side, which basically tracks performance of MB sovereign index, the iBox African sovereign index against the volatility index. And what this chart shows is that over the last couple of years, at least, the performance of these indices, emerging market and African indices, have been positive and trending in the right direction. And of course, there have been ups and downs. When volatility has peaked, that you can see there have been dips in both the MB and the African sovereign index. But what was encouraging is that the African index had lower troughs and lower peaks. It was more consistent and less volatile in its appreciation over the last couple of years. This trend has been bucked, obviously, since last week. We've seen a massive sell-off in emerging market and risk assets across the board, which has resulted in a depreciation in both these indices, as you can see in the right-hand side of that on that chart. But if you zoom in and just look at what some of the main components of that African index, the chart on the top left shows how yields have moved as well across the major economies on the continent. And basically, since the 1st of April, before the tariffs were announced, till the 7th of April, which was on Monday, we saw a massive widening of credit spreads. So just to give you a flavor, Angola, for example, on average widened 275 to 350 basis points, Nigeria 190 basis points on average, Gabon 325 basis points, and then you had the likes of Rwanda 200 basis points, Ivory Coast 135 basis points, and Benin 130 basis points. So there's the differentiation between the oil or energy exporters versus the importers. You can see that the Angolas and Nigerias and Gabons have widened out significantly more than the more energy importing countries like Ivory Coast, Benin, and South Africa, for example. This widening was pared back yesterday slightly, anywhere between 30 and 55, 60 basis points across the board on possible respite from the headlines that we were seeing coming out of the trade wars. But this morning, unfortunately, spreads have widened out again, given the new tariffs that have come into effect, and the extra tariffs that have been imposed on China. I think it's around 104% on certain items. So it's been quite a difficult environment. I think markets are a little bit dislocated. There has been indiscriminate selling of risk assets, which has resulted in yields widening out across emerging frontier markets, but also in other parts of credit and, in fact, rates as well. Um, this obviously has been disproportionately high for emerging and frontier markets like Africa, which basically means that there are higher risk premiums implied in how the yields have moved up in the last 1 week due to the selling action of international investors.
So I think you've hit the nail on the head there in terms of why we've approached this report or the white paper using a scenario-based methodology. I mean, the volatility is quite unprecedented, and we do not want to be reactionaries and look and provide knee-jerk reactions to current developments and have a longer-term view. And we've mapped out three possible scenarios where things can pan out. So the scenario framework helps map those exposures that Faisal spoke about in practical terms, where investment is likely to land and where trade disruptions are most sensitive, but also where access to finance could narrow. And I think this is something that's quite peculiar and interesting to that a few of the findings that came out from our research. So it's not only about predicting which scenario will play out, which is usually the common assumption of what scenarios do, but also stress testing the assumptions under each of these pathways. So that gives us a clearer, a more forward-looking view of where exposure is rising, where buffers currently exist, stress testing those, and how credit conditions may evolve in the long term. Also, from a geopolitical perspective, which is something quite key here, it's becoming a more and more important dynamic to follow and to assess. African economies are now dealing with particularly a US that is less interested in multilateralism and more focused on conditional, bilateral, or if you want to call it transactional engagement. So that is already visible in the way the trade benefits are being reassessed, and as we've seen with the widespread tariff shakeup, GOA eligibility, and it's something that we've also looked at in quite a bit of detail, and also how digital infrastructure is being politicized and investment flows are being narrowed around these strategic values.
I'm actually going to bring up the AGOA beneficiaries map there. I think it would be quite interesting if you can elaborate on that. I mean, what do you envision as the next steps for regional markets, considering these recent actions that we're seeing coming out of the US? Are we very nervous around AGOA continuity?
So under our second and third scenario, particularly, and also a report that we published on Pangea-Risk's platform today, we believe that the prospects for renewal appear more and more limited. So a broader shift away from trade preferences suggests that AGOA may be allowed to lapse, which could likely trigger a decline in US sub-Saharan trade. And this also could accelerate Africa's trade pivot towards alternative partners such as China, the European Union, and the Middle East. Also, intra-Africa trade may see rise, where already preferential arrangements remain in place. So I think there will be a scuffle for finding these new opportunities and new trading partners or growing them. But in the absence of US incentives and industrial growth around and job creation in African economic sectors, particularly around garments, automotive industries like in Morocco, and agriculture in most of the continent, may stall or even reverse. So weakening the longer term economic ties with the US, particularly if scenario two and scenario three, those two or combination of those two manifest. However, countries, this is where the opportunity comes in, that align with Trump's critical minerals agenda, particularly by offering US firms access to strategic minerals, may be able to negotiate new bilateral deals to sustain these industries. So there's a growing policy push from within the US administration, including frameworks such as the Project 2025 that argue for reduced US engagement in multilateral funding, which is something, again, that's quite key in terms of what we've been covering and following over the past few weeks. Now that Treasury has pushed back against this full withdrawal from multilateralism and IMF programs and World Bank and so on, but even a small partial disengagement, such as delays in the IDA replenishment or blocking of IMF quota reforms, would directly affect African sovereigns that rely on timely program support to manage liquidity. So countries like, particularly like smaller countries such as Eswatini and Lesotho, which rely heavily on apparel exports to the US, are now at the risk of margin erosion and foreign exchange tightening if market access is reduced or priced up. Also, if you want to look quickly at the larger markets such as South Africa, Nigeria, and Kenya, the response will center on trade diplomacy specifically and how they react to these tariff policies, but also capital diversification. So several of these countries are already, as I mentioned before, recalibrating toward the Gulf or Chinese funding sources, but those alternatives bring their own conditionalities and liquidity constraints. So the next steps are not just about securing finance, which has been the crisis mode that we've seen post-COVID right up to this stage, but they're also about preserving the predictability in trade, investment, and program engagement.